The Curve with Michelle Martin and Bernard Lim replay from Money FM 89.3.
Well, quick check of local equity markets today shows that the Straits Times Index is still down by about 1% and looks set to close below 3,200 on the last trading day of the week. But we shift our focus now into the forex space, and we're seeing a bit of a mixed bag when you look at major currencies, especially with FX traders dealing with a lot of macro events over the last 48 hours. You're seeing the euro actually taking a little bit of strength against the U.S. dollar today. They are up to about they are now worth $1.12 per euro. The Japanese yen taking a little bit of strength with a seeming flight to safety, seeming to benefit the Japanese yen. Meanwhile, you're seeing the British pound also just relatively stable at worth $1.30. But you're also seeing the likes of the Singapore dollar today. Just a quick check of the local currency shows that there is just a little bit of wobbliness, currently at about $1.36 to the greenback for the local currency. Forex traders have a lot to deal with today. There was the release of dismal of trade figures from China earlier this morning, which followed the ECB lowering their growth forecast for the Eurozone. And this sent just a couple of ripples and a couple of challenges for Forex markets to deal with. So we have joining us on the line now FXTM analyst Jameel Ahmad to help us parse through some of the issues that we're seeing and some of the major developments we've seen in the Forex space over the last couple of days. Jameel?
Good morning. Thank you very much for having FXTM on your show once again.
We have to start with the Chinese yuan today, and I was going to ask you about the MSCI's decision to quadruple its weight for Chinese equities on its global equities, which could bring in some inflows to support the yuan. But this morning, we were hit by the news that Chinese exports in U.S. dollar terms fell by more than 20%. And again, this bringing up concerns about possible the trade surplus for China narrowing again, and also perhaps just bring some questions as to what this might do for the onshore and the offshore yuan. What is FXTM's take, given all of this barrage of developments hitting Chinese markets and possibly hitting the Chinese yuan?
Well, look, what I'm focusing on and what I'm looking at is quite solely the continuation of the narrative provided from the ECB yesterday, what's impacted market sentiment throughout this trading week, and that is fears over slowing global growth. It's not a big surprise. It's not something that we didn't know, but it's something that investors are still struggling to react to. So this data out of China today, the slump in exports, the warnings from the ECB, the weak economic momentum seen in South Africa earlier this week, the warnings from the Federal Reserve, it all combines into the exact same narrative. It's that central banks, authorities, influencers are concerned over a slowing world economy, and this is why FX markets and global equity markets are performing very erratic. That trend's no different for the Chinese yuan to what it is to a developed currency or an emerging market currency. Every single central bank right now and everyone in the world economy is concerned over the slowdown in global economic momentum.
If that's the case, then Jameel, could there be an argument to be made? Is the argument then that safe haven currencies might be benefiting given all of this uncertainty and these concerns of a global growth slowdown? And if so, are there any particular safe havens that actually might be look better than others?
I like the Japanese yen. I've always liked the Japanese yen, and we've seen it for a long time now. When there's uncertainty in the market, investors are extremely loyal to the Japanese yen, and when it comes to adding safe haven assets into their portfolio. Of course, over the past couple of weeks, we also saw this trend with gold as well. The gold has managed to strengthen a lot in 2019, and it still has the potential to go further, but it just happens to be because the US dollar is strengthening, we're not seeing specifically those safe haven flows into the yen and gold yet. But of course, the massive story now is that as the euro tumbled, as other global currencies are weakening, the US dollar is storming ahead, and it's going to be something that the US administration are not going to be too happy with.
We're still speaking to Jameel Ahmad, an analyst over at FXTM. And staying with the Chinese economy here, there is one economy that seems to be rather closely tethered to the fate of Chinese exports and the Chinese economy, and that is Australia, especially with regards to the Australian dollar, which seems rather sensitive to developments over in the mainland. Can you give us FXTM's outlook for the Australian dollar given all of these developments?
The correlation between what can happen to the Australian dollar and what can happen with the major fundamentals in the Chinese economy are very strong. In fact, the trend of the Australian dollar is usually not a story of Australian economic fundamentals, but what the headwinds or what the sentiment is around China. And we do definitely see this risk of slowing global growth. We've seen that the Beijing authorities they sent a lower range for economic growth in 2019 than the past 2 years. This is negative for the global economy, so this is why the Australian dollars also took a hit. What I would look out for in the Aussie dollar, and the reason why I remain negative on the currency, is that the Reserve Bank of Australia have also hinted that they could potentially ease monetary policy further, and by ease, that usually means lower interest rates or something else that could be introduced to stimulate the economy, as in the ECB yesterday introduced new loan scheme to banks.
And with regards to all of these developments in the ECB, also with them lowering their outlook for growth in the Eurozone, how is this affecting FXTM's outlook for the Euro?
Well, we were bearish on the euro anyway, and we still maintain quite a negative view on the euro. It's not necessarily that the EU economy is the only one that's seen as in, I would say, pressurized times because of these concerns over slower global growth. It's just that Europe is very much the weak link. Europe is exposed to trade concerns. It's reliant on trade with both China and the United States. It's also got this somewhat cloud of uncertainty over Brexit, of course, not as strong as the United Kingdom. And then you've got Mr. Draghi yesterday. He issued the downbeat tone that we were already expecting, but it was the market reaction. The market reaction shows that everybody believes the ECB are behind the curve. There's little confidence that the ECB have the tools at their disposal to ease monetary policy further to the degree that could boost the EU economy. Remember, the ECB has already introduced QE a long time ago, and they've got interest rates at record lows that are so low that I can't even remember the exact digits. And this is why the market's very bearish on the euro.